there's a new source of flows, which did not exist for much of the Bitcoin history, which is institutional adoption and possible government adoption of Bitcoin. Copper versus gold, a copper-gold ratio marking Bitcoin's relationships. When industrial activity is peaking, that's a high copper to gold ratio. Could that signal a peak in Bitcoin's prices? Look at the current ratio. It's not signaling a top. Four times the major highs in Bitcoins corresponded to an ISM high. But ISM is not signaling a top currently. It's still well below 50. Crypto fear and greed index, we're at an extreme fear reading right now. These are levels that you saw at the April tariff lows. So I don't think this is a time to be panicking.
Tom Lee opens with a broad look at Bitcoin's price history, noting that the market consistently follows a 4-year rhythm. Since 2010, Bitcoin has moved through nearly 4 full cycles, each ending in a year-long bear period. While this was once widely attributed to the halving, Lee explains that today's landscape is more complex, with institutional adoption, global liquidity, and macro forces now playing a significant role. He breaks down 5 possible drivers of the cycle: halving-based supply changes, monetary policy, retail speculation, industrial activity, and the broader business cycle. Surprisingly, real-world indicators like the copper-to-gold ratio and manufacturing strength align most closely with Bitcoin's major tops, suggesting its trajectory is now tied more closely to global economic momentum than simple supply math. Before we continue, please like the video, subscribe, and turn on notifications so you don't miss upcoming market insights. Your engagement supports the channel and helps us keep bringing you in-depth crypto analysis. Enjoy the video.
So you wonder, what is the Bitcoin 4-year price cycle? Well, it is something that is hard to explain, but if you look at Bitcoin's price since 2010, and we've marked it with the green lines, there have been 3.91-year cycles. And at the end of those cycles is a 1-year bear market. Now, why is this happening? In the past, I would have said it was because of the halving cycle, which happens roughly every 4 years. But there's other possible explanations. It could be monetary policy related to M2 and Fed action. It could be a speculation cycle related to margin debt. And keep in mind, Bitcoin until the last couple of years was retail only, but it's different today because of institutional investors. But it could be industrial related. It could be that there's an interplay between gold and Bitcoin and copper. In other words, an industrial activity ratio. And finally, it could be business cycle related too. So let's examine these 5 possible explanations. So the halving is when the Bitcoin block reward is cut in half. It does reduce supply. So in the past, I would have said that this could explain Bitcoin's price action. And as you can see, the halvings occur here. Now, again, I would have bought into that view, except in the last few years, there's a new source of flows, which did not exist for much of the Bitcoin history, which is institutional adoption and possible government adoption of Bitcoin. And another reason I'm not necessarily believing this is that there's a lot of other things that are in a 4-year cycle: presidential cycles, leap years, Olympics, FIFA, the World Cup, and rugby, etc. So let's switch to monetary policy liquidity. That could explain things, whether it's the Fed cutting rates, quantitative easing. I think those are, in the near term, definitely important factors. But do they explain the 4-year cycle? We could look at M2 supply and see if that explains 4-year cycles. In other words, is there a monetary cycle of 4 years? Well, the reality is, if you look at the peak of Bitcoin prices, it has not been affected by Fed liquidity. So I don't think that's the explanation. Well, let's talk about retail margin debt. Now, this could explain something because we know retail investors were buying Bitcoin in the early days, and they continue to, but they're not the only source of flows today. As we can see, a lot of this is institutional money. But you can go to FINRA, get the margin debt, and this is what the chart looks like. So, I think it looks a little cyclical. In fact, if I overlay this with Bitcoin's price, they do look somewhat related. But here's the thing, the peaks don't match up. Bitcoin enters a bear market even as margin debt is still going up. So I don't think margin debt really explains Bitcoin's peaks. So that gets us to copper versus gold. Someone on Twitter posted this, named AOBTC analyst, and I thought it was interesting. This is saying, is there a copper gold ratio marking Bitcoin's relationships? Here's why that's interesting. Copper versus gold is a measure of industrial activity versus a fixed monetary base. So when industrial activity is peaking, that's a high copper to gold ratio. Could that signal a peak in Bitcoin's prices? Well, let's overlay that chart. And if we look at the peaks in that ratio, in fact, it does correspond very well with the peak in Bitcoin prices. So I think that this is actually very explanatory, but look at the current ratio. It's not signaling a top. And let's think about ISM manufacturing along that same line. ISM is really the most important measure of US industrial activity. When that index is above 50, the economy is expanding, and when it's below 50, it's in contraction. So the business cycle peaks are marked here. Current reading is 48.7, so the ISM says we're not solidly in expansion territory, and of course, nowhere near a peak. Well, how does that compare to Bitcoin's price? If you look at the peak in the ISMs, they do correspond really well with Bitcoin's peak in price. In fact, four times the major highs in Bitcoins corresponded to an ISM high. But ISM is not signaling a top currently. It's still well below 50. So here's our take. I think the halving cycle worked in the past, but I think there's too many things that are 4 years. The monetary policy cycle really doesn't explain the 4-year cycle. It explains Bitcoin in the short term, but not on a 4-year basis. The speculation cycle doesn't really work because it only explained one of 3 margin cycles for Bitcoin. But this gold versus Bitcoin versus copper, yes, it does seem to really be explanatory, and it's telling us we're not really near a top because industrial activity isn't peaking. And then finally, when it comes to the business cycle at ISM, I think it is actually quite explanatory, and again, not a sign of a top. So our takeaway is the Bitcoin price cycle actually seems to follow industrial activity and gold. And the message currently is HODL. I wouldn't be giving up on Bitcoin and assuming the price has already peaked. Well, let's talk about Ethereum for a moment. Now, Ethereum is continuing to trade in this large base as we're highlighting here. But as you know, crypto suffered a massive liquidation on October 10th. And we pointed out that the languishing of crypto prices in the past 2 weeks since October 10th has the signs of a market maker, or maybe more than one, having a problem with their balance sheet. That means they need to raise capital. They're, of course, not taking risk and providing liquidity to markets. And of course, that means sharks are circling because they know there is price vulnerability. They're going to try to force prices down because that would create further problems, and that's where the asymmetry is. Until the market makers fix their balance sheets, and that takes time, sharks are circling. But this is the message to me. I just wouldn't be using leverage. I don't think this means crypto is broken. And in fact, as you can see on CoinMarketCap's Crypto Fear and Greed Index, we're at an extreme fear reading right now. These are levels that you saw at the April tariff lows. So I don't think this is a time to be panicking. And of course, positive things keep happening on the blockchain. This is Ethereum's block space at an all-time high. Of course, stablecoin creations on Ethereum are an all-time high. And many crypto experts are talking about why Ethereum is really where a lot of people are building. So this takes me back to this fact that I think Ethereum in 2025 is having its 1971 moment. Many companies are building projects on Ethereum, and most of the value in terms of tokenized assets are taking place on Ethereum. And that tells me that Ethereum's price to Bitcoin ratio should start to get to at least its 8-year average and probably get to an all-time high. And that means that if Ethereum gets to its 8-year average price, that's about 12,000 Ethereum. So Ethereum is really undervalued currently. And if it gets to the 2021 high ratio, that's 22,000 Ethereum. And of course, if Ethereum becomes the payment rails of the future, that's $62,000 Ethereum. So you can see Ethereum at its current prices is drastically undervalued. And that gets us to the third topic, which is tokenization. Now, you've heard a lot of people talk about tokenization, but I want to explain why it's a huge unlock, okay? Larry Fink says we're at the beginning of tokenizing all assets. I mean, he's talking about stocks, bonds, and Vlad at Robinhood is saying the same thing. Now, there's 5 reasons why tokenization is important, okay? It's fractional ownership. It reduces cost and efficiency for managing securities. Therefore, it's better for the investor. It allows 24/7 global trading. You get a lot more transparency and security, and hopefully over time you get increased liquidity. So what does this mean? Well, it means that In 1971, Wall Street was in its earliest stages of innovation. We are here today, 2025, but tokenization on Ethereum is going to take us into the future. So what is tokenization? Let's just take a Rembrandt painting to illustrate. And to tokenize it, we can break it into its components. And in theory, someone could just say if they're doing fractional ownership, they just want to own this part of the Rembrandt. Okay, that is fractional ownership. But you can also factorize on the blockchain. And what does factorize mean? Well, it means taking the painting and then breaking it into its base colors. Okay. And therefore, you can do that with a business. Let me give you an example with Tesla and unlocking Tesla by factorizing it. You can time tokenize Tesla. That means you can buy the earnings on a specific date in the future. You can product tokenize. You can buy the present value of a specific product stream. You can even geographically tokenize. You can buy the present value of a regional portion of Tesla's sales, or you can financial statement tokenize. Now, why am I pointing this out? You need liquidity to create these, but you also need smart contracts, a lot of good technology, and a lot of good code. And that's what's happening on the blockchain. So here's an example of time tokenization. Tesla's stock price is really the sum of all future earnings. And we know that, for instance, Elon's going to get a 10-year pay package worth $1 trillion if he delivers value for Tesla shareholders. Well, what does that mean? That means that you may only want to buy Tesla's earnings in 2036 when he gets the payoff. Well, that's an example of time tokenization. Now, there's a second way to look at this, which is product tokenization. Tesla is comprised of the present value of its various streams of EV, robotaxi, prime robots, FSD, solar, and of course, the future, which is Elon's brain. Someone may only want to buy Elon's brain, and therefore a tokenized Tesla is a bet on that versus everything else. So you get the picture. And finally, on digital asset treasury fundamentals, we've talked about this many times, so I'll cover this quickly. There are many ways to increase Ethereum per share, issuing stock at a premium, using equity-linked securities, income from operations, earning staking rewards, and acquiring other DATs. And Ethereum treasury companies are crypto infrastructure businesses. Ethereum is a proof-of-stake blockchain. Ethereum generates a staking yield, and staking is securing the network. So it is an important function that one would do by staking. And of course, eventually stablecoin issuers and those tokenizing real-world assets are going to want to stake ETH because they're going to want to have some governance, and that's, again, providing network security. So as you look at our roadmap, we are getting involved with the community. We are going to do moonshots, and of course, work our way towards the Alchemy 5%.
A key takeaway from Tom Lee's analysis is that Bitcoin's price movements aren't random, he argues. They follow a consistent 4-year pattern that has held since 2010. While the halving once seemed like the obvious explanation, Lee notes that the market has matured, and institutional capital, government interest, and macro forces now play a much larger role. He evaluates several theories: retail leverage, liquidity, and speculation, and finds that none fully account for Bitcoin's recurring peaks. Instead, economic indicators like the copper-to-gold ratio and the ISM Manufacturing Index show the strongest alignment, suggesting Bitcoin is increasingly driven by real industrial and business cycles, rather than purely crypto-native events. Despite recent market stress and heavy liquidations, Lee remains constructive. Current economic readings don't resemble previous cycle tops, and ongoing growth in blockchain activity, tokenization, and Ethereum development point toward long-term structural momentum. In his view, investors may still be early in a broader transformation that will define the decade ahead. If you're enjoying the analysis, don't forget to like the video, subscribe, and hit the notification bell so you never miss future updates.